The bond market is sounding an alarm right now. And if you are not hearing it, you may be walking into a major financial danger without even realizing it. While the world was in holiday mode, something unusual happened in the global financial system. The yields on U.S. Treasury bonds, which the Federal Reserve is supposed to keep under control, began rising rapidly instead. In early 2025, the 10-year U.S. Treasury yield climbed above 4.80%, reaching its highest level in months. Here is the strange part. This surge happened after the Fed cut interest rates. Normally, rate cuts make borrowing cheaper and bond yields fall. But this time, the market ignored the Fed. Yields went up when they were supposed to go down. This is not a normal market move. It is a sign the market is losing confidence in authority. The reason is simple. The buyers are disappearing. For years, foreign central banks were the largest financiers of U.S. debt. Now they are not buying. They are selling. China's Treasury holdings have dropped from about $1.3 trillion to roughly $680 billion. That is nearly a 50% reduction. India is doing something similar, reducing bonds while aggressively accumulating gold. In Europe, an even more serious topic is being discussed. If political tensions with the United States rise, restrictions and forced sales of dollar assets could follow. This is not a conspiracy theory. It is based on official data, and that data suggests the largest debt bubble in history may be starting to crack. The bond market does not hide reality. Politicians can be wrong. Central banks can make mistakes. The media can ignore it. But prices do not lie. Rising 10-year yields show that markets no longer fully trust the Fed. Investors are now pricing risks that were previously ignored. When yields rise, bond prices fall. So investors holding long-term bonds are already watching their assets lose value. And the impact goes far beyond investors. The U.S. government now spends over $1 trillion per year just to pay interest on existing debt. If rates stay at these levels, that cost will climb even higher. The housing market is directly affected as well. As mortgage rates rise, buying a home becomes harder. Monthly payments for the same house can nearly double. As a result, either home prices must fall or buyers leave the market. Both outcomes slow the economy. Businesses face similar pressure. Companies that borrowed during the low-rate era now must refinance at higher rates. That increases bankruptcies and layoffs. This is how recessions usually begin. So why are yields rising? Because demand is falling. Global confidence in U.S. debt is weakening. China is selling treasuries and not holding the dollars as cash. Instead, it is moving into gold. Because gold cannot be frozen, cannot be sanctioned, and does not depend on any national currency system. India, Russia, Turkey, and many other countries are also diversifying their reserves. In recent years, central bank gold purchases have reached historic highs. For the first time, the total value of gold held by central banks has exceeded the value of U.S. treasuries in their reserves. This represents a major psychological shift in the global financial system. The United States must borrow trillions of dollars every year. If foreign buyers stop purchasing, only one buyer remains: the central bank. And that means money printing. The cycle looks like this. More debt leads to higher interest rates, leads to larger budget deficits, leads to more money. Printing leads to higher inflation, leads to weaker currency, leads to more selling. This is a debt cycle. What does this mean for individuals? Stocks depend on foreign capital. Bonds lose value when rates rise. Cash loses purchasing power through inflation. Because of this, many investors are moving into assets that cannot be printed: gold, silver, commodities, and scarce digital assets. For decades, the dollar symbolized global stability, but cracks are beginning to appear. Historically, reserve currency transitions are painful. Countries that experienced them faced long economic struggles. This process does not happen overnight. It can take years, but purchasing power declines over time. You can appear wealthier on paper while actually becoming poorer. That is the hidden effect of inflation. Global financial balances may be shifting. Gold is rising. Interest rates are increasing. Central banks are restructuring reserves. The bond market is signaling change. This will not be a single sudden event, but a long-term transformation. Understanding these developments and building financial awareness has never been more important. The reality is this: this will not happen overnight. It may be a slow decline spread over many years, and that is exactly the danger. You might have $500,000 in your account. But if in a few years that money can only buy what $200,000 buys today, you did not get richer, you got poorer. That is how inflation works, like a hidden tax, quietly eroding purchasing power. Today's picture is clear. China is reducing dollar assets. India is accumulating gold. Europe is discussing financial responses. Gold is reaching record highs. Interest rates are rising. The bond market is clearly signaling change. This could be one of the late stages of a debt-based monetary system. The real question is this: will you notice in time and prepare? Or will you be one of the people wondering years later why your money no longer goes as far? If this video gave you a new perspective, don't forget to subscribe and turn on notifications.